I was listening a little bit about, or reading a little bit about, what Mark Farber was saying very recently. Now, today is July 27th, Friday, 2012. And we know there's a couple things coming up. They're trying to resolve problems with the European debt. Now, he says over the next 10 days, you should wait it out a little bit to see which direction it goes. Now, he says his strategy is, since he doesn't know, he'd rather be diversified than try to be an aggressive trader and jump into one area and then jump into another area and that type of stuff. His strategy is diversification. So he always, but he's not stupid. You know, he's over 25% invested in gold. He's a big believer in gold. He doesn't want to have too much cash. He's not, you know, he has a good cash buffer. He's also 25% into Asian equities. He believes equities will do better than the bonds. You know, he doesn't trust the bond market. He does have some cash and that type of stuff. But he's saying that over the next 10 days, there could be a problem with the markets. You know, maybe there could be a downturn or an upturn. He's not sure, but there's some problems that need to be ironed out with the European situation. Plus, I also mentioned next week, on next Thursday, I think it was around August 2nd, around that particular time, the United States, they need to vote if you know, they're going to raise the debt ceiling. Well, they have to raise the debt ceiling or else the U.S. will be in default. Now, obviously, the U.S. is not going to be in default, but there was a big scare last year that it could. It was getting very close and critical to that time. And they were arguing back and forth. And, you know, I saw these articles recently about it cost them $1.3 billion because of all the bickering they had last year about stalling about raising the debt ceiling, you know. So what can happen, McGann, is maybe the same thing. Now, what I think is that little articles that are being spiked, I call them being spiked, about the $1.3 billion going, you know, costing them that much more money by stalling, is they just want to have, like what Soros says, George Soros says this too, just raise the debt ceiling, don't argue about it, and just work out the details later, you know. I don't think it's going to work out that way because it's a political year with, you know, re-elections and all this type of stuff. Now, I'm going to look at, you know, the markets right now are, you know, anybody can look this up. I like using Kiko's site, but, you know, pretty much flat. Nothing's going on except the Dow is looking good. Now, I want to actually remark a little bit about this Dow situation. You know, it's up to almost 13,000 now. By the way, gold is right around 90. You know, I mean, gold. Oil is right around $90. Now, I want to remark a little bit about this Dow situation. You know, it doesn't really jive in with the metals. And I know people got tunnel vision on silver, but look at all the commodities. All the commodities are down except for one area, agriculture. Agriculture, and that's due to nothing in the financial world per se that's bringing it up. It's due to drought. You know, 62% of continental United States is a drought situation, and it's continued. So there's a shortage of crops and all that stuff. But you know, this almost not exactly the same. But you know, I always think about this. You know, I don't have numbers in front of me, but just thinking the situation through. Didn't a lot of banks lend money to these farmers and stuff like that? Don't they usually borrow money, or corporation farmers, whatever the hell they are? Aren't a lot of people suffering a major economic downturn because of this drought, even including all the people that transport all the goods on the Mississippi? And isn't a lot of industries interlinked, and isn't there a lot of secondary industries throughout the Midwest that are all linked into this agricultural? Like, I'm not, you know, I'm from New Jersey, New York, but I realize that's a major vital industry. So being up from the city and I know nothing about agriculture, I'm not trying to say, I'm trying to state that it's extremely important financially. So actually, I think that puts a number of financial institutions and banks on the line. In other words, maybe right now they don't want to admit they have troubled assets or troubled loans to a lot of businesses out there, and maybe they do. You know, in other words, they always drag their feet in writing things down. So this could actually bring about a lot more economic calamity in the future, not just due to high food prices, but how it affects the financial system. Remember, all these businesses that are associated with agriculture and transportation of agriculture and all the supporting machinery and whatever else is out there, they're all operated on money and finance. They grease the wheels. If the mission doesn't get accomplished, the money and the grease is in there. So a lot of times, if you even think back to the 20s, what happened with the stock market? The big signs were the problems with the agricultural community too before it crashed. So the metals are down due to low industrial demand, right? All the metals, not just silver, all of them, pretty much all of them. I mean, copper's not getting killed too bad or nothing, but it's kind of like a little bit in short supply, believe it or not, even though it's abundant, it's used a lot. But basically all the metals like zinc, aluminum, and all that stuff, they're all down. Now, that tells you there's industrial output is lousy throughout the world, which means, the GDP numbers that they're throwing around for the U.S. probably don't mean as much as, the numbers say. Now, you also look at the output for agriculture. Even though the prices are up, the output's down. It's not a matter of there's a big demand. It's the matter of there's a small supply because of drought conditions. Yet the stock markets are still going up. I don't know about that deal. Mark Farber says equities. He's mainly saying Asian equities, and he handpicks them. I personally think the stock market is a dangerous area, and actually probably a lot of people do. That's why they're in bonds, and that's why there's a bond bubble right now. So just follow out some of the very simplistic things, and you can pretty much know exactly what's going to happen. The stock market probably is overinflated, but so is the bond market. It's kind of making things a little less and less attractive for that, and looking at the commodities as more attractive because they're all suppressed. They're the next thing that's going to rise. Now, the other thing is printing money, printing money. That's why you go into real assets. Now, Mario Draghi is, over in Italy. Super Mario is basically like the same as Ben Bernanke is to the United States as Mario Draghi is to Europe. He's the same kind of character. They both say they're both going to print money. To me, go right ahead, because I'm all in gold, silver, platinum, and palladium, and if you print money, it's just going to make that asset class go up a lot faster than everything else. But the next scam that's going to happen, and you can look this up on Wikipedia, European Stability Mechanism. They got their official definition, but I like this definition a lot better. And it explains how, and this is a little thing to Lindsey Williams, because he's right. They're going to break everybody with debt, all the nations with debt. So here's the European Stability Mechanism. Money is first borrowed from the European Central Bank, the ECB. The ECB, the European Central Bank, which has no money, and then the bond, it doesn't have any money, it just created, and then it's borrowed from the European Stability Mechanism. The ESM, the European Stability Mechanism, doesn't owe money to the ECB. It's the individual nations that owe the debt to both the ESM and ECB with interest. So it's a game that's locked in that you can't freaking win. There's absolutely no way. So they're going to create the money out of thin air, keep the debt piling up, keep the debt piling up, pay it back with interest. And, you looked at the case of Greece, they're trying to get down to 120% of their GDP by the year 2020, which takes 8 years. They can't even do that without actual massive loans and stuff like that, and that's considered very draconian. So, I don't know. This game looks like, what Lindsey Williams says, what the elite are doing is bankrupting all the nations through debt. It's quite obvious that they're doing that. It's quite obvious. So, I talked a little bit about entrepreneurship, and I think that's probably one of the ways to go. And problem is, even if you get on a small level, say for instance, say you're making bikinis or something like that, that's probably a good racket. If you have small bits of cloth and a sewing machine, you could probably sell them for pretty good bucks. But there's always all this stuff out there. You have to have like the liability insurance and on anything, product liability insurance and stuff. there's so many, and people stealing your ideas is all that kind of garbage. But a lot of it is excess regulation. I was talking about this before, but the game they got going on here, it looks like killing real production all the way across the board. And as far as keeping your money 100% into silver, that's the one thing I always have a problem with. If they're actually killing the economies per se, and the economies are being dragged down, I personally like silver, platinum, and palladium because they have real industrial use. But if you're dragging down the industry, what the hell's going to happen to those metals? All right, that's the one thing I don't like about that deal, and that's really what's the problem is right now. The numbers actually coming out for the global primary manufacturing index are looking worse, like we saw the recent ones in June 30th. Now, next week we'll see what's going to happen for July 31st. It may be up slightly, but it's still going to be down pretty good. But I also think that those numbers are somewhat rigged, because you can really tell what's going on better with the economy through the commodity prices. And if you took out agriculture out of the equation, you looked at all the rest of the commodity prices, they all look severely depressed from the beginning of the year. That tells you a lot more about the economy than what's going on. So, I don't know. I think between Bernanke and Mario Draghi, we're probably going to see a lot more stimulus spending, though, and I think that is going to be the basic policy that's going to come about. I also suspect there's going to be a downturn in not just the bond bubble is something that a couple people were talking about besides Mark Faber, but it's probably a bubble in the stocks too, even the equities, the S&P and the Dow. They can all go turn down quite a bit, and I think if those go down, then you're going to see massive stimulus spending, which could actually bring up the price of gold and silver several times, for all I know. I mean, I could be guessing wrong about the $60, $70. It could go straight to 200 for all I know. But I think the watchword is to do things in pieces and be cautious. And very carefully watch the tone of what I call the silver pump and dumpers, because they seem to have uncanny timing as to when to sell and when to buy. And I'm not trying to save the world here, but I'm giving out my very candid advice, because I see that the best people know exactly when to sell, and they know exactly when to buy. And I can tell you right now, this is a better time to buy. They're all going to be screaming on the top of your lungs to go buy everything there is when it's over 50. But, you want to buy it now when it's 27, really. This is the time to buy. When the silver crowd starts screaming, keep buying at 50, I don't know about that. There might be a pullback at 60 or 70. I don't know. I don't know about that 100%, but watch their tone, because that could give you a little more leeway as far as timing in and out of the markets. But I would only play that game with some of it, not most of it.